I mean, I can't even imagine buying a stock that doesn't pay a dividend. Why would you do that? What would be the reason you would do that? I don't get it.
Kevin O'Leary is a businessman, entrepreneur, and maybe best known for his role on Shark Tank. But what a lot of people don't know about Kevin O'Leary is his love for investing into quality dividend-paying stocks. In this video, we're going to be looking at the top 5 dividend stocks in Kevin O'Leary's portfolio. But first, we do need to answer the question, why does Kevin O'Leary love investing into dividend stocks so much? I'll let him explain it himself.
If you look at the volatility in the market around names that don't pay dividends, they're extremely volatile because there's no cushion of yield. What's the value of a stock that never returns capital to its shareholders? I don't know, because the only way you can make money is if somebody else is willing to buy that position at a higher price for some emotional reason perhaps, or for some foresight that maybe the company will return capital one day. And I think of when you learn as an investor over multiple decades is the only thing that matters is free cash flow. That's it. There is no other reason to own a stock. And with that philosophy, it brings you into a place where you focus on a company's ability to generate incremental cash flow, because just owning a dividend-paying stock is not good enough. Because let's say we find a stock today that's paying a 3% dividend yield, and tomorrow, because its forecast for sales get cut in half, the stock drops by 50%. Now it's yielding 6%. I don't want to own that stock either. I mean, I can't even imagine buying a stock that doesn't pay a dividend. Why would you do that? What would be the reason you would do that? I don't get it.
Kevin O'Leary begins to hint that there are 2 different things that he looks for when investing into dividend stocks. The first is growing free cash flow. The more free cash flow that a company has, the more capital it can allocate to dividends, paying down debt, and business growth opportunities. The second is dividend growth. When dividend companies are able to continue growing their free cash flow over time, this gives them the ability to continue to increase the amount they pay in dividends to its shareholders. With this in mind, Kevin O'Leary created his own dividend ETF, stock ticker OUSA, with a focus on companies that increase free cash flow and dividends over time. To analyze the top 5 companies in this ETF, we'll be using 2 different valuation models, the discounted cash flow analysis and the dividend discount model. These valuations go hand in hand with Kevin O'Leary's investment style as they focus on free cash flow growth and dividend growth. If you'd like to be able to download the spreadsheet used in this video, then you can head over to my Patreon page at the link in the description. The first and largest position in Kevin O'Leary's dividend portfolio is Johnson & Johnson, stock ticker J&J. Now this position takes up over 5.5% of Kevin O'Leary's dividend portfolio, and it's also a company that's been increasing the amount they pay in dividends for over 61 consecutive years, which makes them a dividend king. But let's go ahead and jump into our stock analysis spreadsheet. So all we need to do is we'll come up here and plug in the stock ticker J&J and hit enter, and you can see all of this data is going to automatically load in. Now something we do need to point out is this company currently has a dividend yield of 2.77%. Not bad for a company that is a dividend king and increases the amount they pay in dividends every single year. But let's go ahead and look at the 2 valuation models we're going to look at, and the first is the discounted cash flow analysis. And the idea behind our discounted cash flow analysis is we should be able to value a company based on how much free cash flow they're going to produce in the future. And in order to project that, we need to project a growth rate to those future free cash flows. So to do that, we plug in the historical free cash flows for the company, as we can see right here. And this allows me to see a year-over-year growth rate for Johnson & Johnson. So over the past few years, they've had an average growth rate of about 4.5%. Moving forward, I think it'll be slightly higher than that. So I'm projecting a growth rate of about 6% to the future free cash flows of the company, as we can see right here. After finding the present value of those future free cash flows, we add them together. We add the company's cash and cash equivalents and subtract out their total debt to get their equity value. After dividing by the number of shares outstanding, we come to a discounted cash flow price per share of $176 per share, which is a little bit larger than the current price for the company. So this checks the first box for Kevin O'Leary, as they do have an increasing free cash flow. Now the next thing we need to look at is the dividend discount model. And obviously, if we're going to have a company that continues to increase their free cash flow year over year, we want them to reward their shareholders in the form of dividends. So this is a similar valuation, but we value the company based on how much they pay out in dividends and how much that dividend is increasing. So what I've done is I plugged in the quarterly dividend payouts right here, year over year. This allows me to see the yearly dividends paid out. So now I can see the growth rate year over year. And over the past few years, they've had an average dividend increase of 5.86%. Not bad. So moving forward, I'm projecting a growth rate of about 5.5%. After applying a discount rate of 8%, we come to a dividend discount model price per share of $190. So this company does check the two boxes that Kevin O'Leary is looking for, which is increasing free cash flow and increasing dividends over time. Now, anytime we have a company that is a dividend paying company and has a high dividend growth rate, we do want to jump back over to our stock screener and check that payout ratio. And we can see the payout ratio for Johnson & Johnson at 61%, a little bit higher than I typically like to see it, but not a red flag, as a lot of companies that are dividend kings do typically have a higher payout ratio, but it's still a very safe dividend payout. But let's go ahead and look at our next company. The second largest holding in Kevin O'Leary's dividend portfolio is Procter & Gamble, stock ticker PG, currently trading at $135 per share. Now this company takes up 4.9% of Kevin O'Leary's dividend portfolio, and they've been increasing the amount they pay in dividends for over 66 consecutive years. Pretty unbelievable, making them a dividend king. But let's go ahead and jump into our stock valuation spreadsheet, and again we'll come up here and plug in the stock ticker for Procter & Gamble and hit enter, and we'll see right here they have a dividend yield of right at 2.7%. Again, pretty solid for a company that is a dividend king. But let's go ahead and jump into the first valuation, which is the discounted cash flow analysis model, and we'll do the same thing that we did for Johnson & Johnson, and mainly what we're looking for is growing free cash flow for the company. So we plug in the historical free cash flow for the company, we can see the year-over-year growth rates here: 14.8%, 7.62, 16.85, 8.82, and then we had a slight decline in 2021, which gives it an average growth rate of 7.14%. Now moving forward, I'm projecting a growth rate of 7.75% to the future free cash flows of the company. We then take the present value of those future free cash flows and add them together, add the company's cash and cash equivalents, and subtract their total debt to find their equity value. Once we have the equity value, we divide by the number of shares outstanding to get our discounted cash flow price per share of $137 per share. The current price is $135 per share, meaning that according to our discounted cash flow model, it's trading very close to fair value. But overall, this does check the box for Kevin O'Leary, as we have a clear sign of growing free cash flow. But let's go ahead and look at our other valuation, the dividend discount model. So again, we plug in the quarterly dividend payouts year over year so we can see the yearly dividend payouts, and this allows us to see the year over year growth rate. So we have a growth rate of 4% here, 6% here, 10% here, and 5% here. So pretty solid dividend growth over time for Procter & Gamble, giving them an average growth rate of 6.25%. Now moving forward, I'm projecting a growth rate of slightly below that at 5.75%. With a discount rate of 8%, this gives them a dividend discount model price per share of $171.64, which is a little bit higher than their current trading price. So again, this company checks both boxes for Kevin O'Leary. We do want to jump over to our stock screener and check that payout ratio once again, but we can see it is a safe payout ratio at 58.7%. So this is one of the reasons why this is a large holding in Kevin O'Leary's dividend portfolio. Let's go ahead and move on to our next company. The third largest position in Kevin O'Leary's dividend portfolio is Verizon Communications, stock ticker VZ, currently trading at $41.10 per share. This is a company that's been increasing the amount they pay in dividends for 16 consecutive years, and it takes up about 4.4% of Kevin O'Leary's dividend portfolio. But let's go ahead and jump into our valuations. And again, I've already plugged in their stock ticker here, and you can see their dividend yield sitting very high at 6.23%. This is one of his largest dividend paying stocks when it comes to dividend yield. But let's go ahead and jump into our first valuation model, which is our discounted cash flow analysis. And again, we're going through the same process. As you can see here, I plugged in the historical free cash flows for Verizon, but we have very choppy free cash flow growth. We have a slow year here, a higher year, and then a huge retreat right here at negative 18%. So over just the last 3 or 4 years, they have an average growth rate of about 4.9%. Moving forward, I think it could be even lower than that, so I'm projecting a growth rate of about 3.75%. After going through the same process and applying that to the future free cash flows and finding the present value, we add those present value free cash flows together, add the cash and cash equivalents, subtract the total debt to get our equity value, and after dividing by the shares outstanding, we come to a discounted cash flow price per share of $47.38. So while they do have a slightly higher intrinsic value according to our discounted cash flow model than the current price, we do have very slow free cash flow growth moving forward. So this does not necessarily check the box for Kevin O'Leary, but let's go ahead and look at our dividend discount model. And again, we plug in the quarterly dividend payouts for Verizon so we can see how much they pay out each year. And this allows us to see our year over year growth rates. And you'll notice again, very slow dividend growth. We have 2.2%, 2%, 2.1%, and 1.9%, which gives it an average growth rate year over year of just 2.05%. So moving forward, I'm projecting a growth rate of 2.2% and a discount rate of 8%, which gives it a dividend discount model price per share of $45.11, which again is slightly higher than the current price for Verizon. So although the intrinsic value does appear to be slightly higher than the current price in both of these valuations, this company does not necessarily check the boxes for Kevin O'Leary, what he's looking for with its free cash flow and dividend growth. Now, something you will notice is anytime a company has a higher dividend yield, a lot of the times you are going to see slower free cash flow growth and slower dividend growth over time, but the payout ratio is safe at just 51.1%. But let's go ahead and look at our next company. The fourth largest company in Kevin O'Leary's dividend portfolio is Microsoft, stock ticker MSFT, currently trading at $253 per share. This is a company that takes up about 4.3% of Kevin O'Leary's dividend portfolio, and they've been increasing the amount they pay in dividends for 20 consecutive years, showing a strong commitment to increasing their dividend payouts over time. But let's go ahead and jump into our valuations. And again, you can see right here, I've already plugged in their stock ticker, so this data has loaded in. We can see right here, this company has the lowest dividend yield out of all the top 5 holdings in his portfolio at right at 1%. Now, let's go ahead and jump into our first valuation, which is going to be the discounted cash flow analysis. We'll go ahead and zoom in right here. And what you'll notice is I've only plugged in the past few years of free cash flow growth for Microsoft, but they have massive free cash flow and it's growing at a tremendous rate. Analysts are projecting it will continue to grow at a growth rate of about 17% moving forward, which is extremely high. So I'm applying that growth rate to the future free cash flows, finding the present value of those future free cash flows and adding them together here. I add Microsoft's cash and cash equivalents, which is a massive amount of their company, and subtract their total debt to find their equity value. After dividing by the shares outstanding, we come to a discounted cash flow price per share of $358, far higher than the current price. So obviously this does check the first box for Kevin O'Leary with massive free cash flow growth. But let's go ahead and look at our next valuation, the dividend discount model. And you can see here, I plugged in the quarterly dividend payouts for Microsoft so we can see how much they pay out each year. And this allows us to see the year over year growth rates. And I absolutely love the year over year growth rates for Microsoft, 9.5%, 10.8, 9.8, and 10.7. This gives them an average growth rate year over the past few years of 10.23%. That is extremely solid for this company. So moving forward, I'm projecting a growth rate of about 8.25%. And after applying a discount rate of 9%, we come to a dividend discount model price per share of $357. Again, far higher than that current trading price. So this company does check both boxes for Kevin O'Leary, massive free cash flow growth and really high dividend growth. Again, we'll jump over to the stock screener. And what's even more amazing about this company is a very, very low payout ratio, giving them plenty of room to continue to increase the amount they pay in dividends for a very, very long time. But let's go ahead and jump into our last company. The fifth largest position in Kevin O'Leary's dividend portfolio is Pfizer, stock ticker PFE, currently trading at about $45 per share. This is a company that takes up 4% of Kevin's dividend portfolio and has increased the amount they pay in dividends for 11 consecutive years. Let's go ahead and jump into our spreadsheet. And again, we're going to come up here and plug in the stock ticker PFE and hit enter. And once all this data loads in, we can see this is a company that has a really nice starting dividend yield of right at 3.5%. That's quite a bit higher than most of the companies in their industry. But let's go ahead and jump into our first valuation, which is the discounted cash flow valuation. And again, we're going to plug in the historical free cash flows for the company, as you can see right here. And one of the things that you will notice is year over year, they have a very choppy free cash flow growth rate. So after looking at analysts and industry expectations, I'm projecting a growth rate of just 1%. So that's a little bit of a red flag. They are expected to have slow free cash flow growth in the future. But after applying that 1% free cash flow, 1% growth rate to the future free cash flows, I found the present value, added them together, added the company's cash and cash equivalents, and subtracted the total debt to get their equity value. I then divide by the shares outstanding, and this gives us a discounted cash flow price per share of $51.22. So while this is still slightly higher than the current trading price for Pfizer, that 1% growth rate is a little bit low, and it does not check the box for Kevin O'Leary, meaning we need higher free cash flow growth rate for this to be considered a great dividend growth stock. But let's go ahead and look at our next 2x valuation model, which is going to be the dividend discount model. And again, you should know by now, we plug in the quarterly dividend payouts right here so we can see how much the company pays out each year. And this allows us to see our year-over-year growth rate. As we can see, 5.8, 5.56, really good year here at 8.17, then a slower year at 2.56. But when we average these year-over-year growth rates together, we come to a 5.54% growth rate. Not bad. So moving forward, I'm projecting a growth rate of 4.5%. After getting a discount rate of 8.5%, we come to a dividend discount model, price per share of $41.80. Let's go ahead and jump over to our stock screener and check that payout ratio. We can see they have a nice safe payout ratio right now at just 30.2%. But now you do have to understand that free cash flow is one of the ways that a company can pay out dividends. So if this free cash flow growth rate is just sitting at 1% and they continue to try to increase the amount they pay in dividends over time, that is going to lead to a higher payout ratio over time, which may put the dividend at risk, meaning that the company may not eventually be able to pay out that dividend. So those are the top 5 dividend stocks in Kevin O'Leary's dividend portfolio. This dividend growth investing strategy that Kevin uses allows him to compound his wealth over time at massive rates, and it's the same strategy that I use in order to one day allow me to live off of my dividend income. If you'd like to be able to join me on my dividend investing journey, then be sure to subscribe to my channel and check out my monthly dividend portfolio updates. If you'd like to be able to download any of the spreadsheets used in this video, then you can head over to my Patreon page at the link in the description. So with that being said, thank you guys so much for watching, and I'll see you next time.